The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody, and welcome to our webinar with the CoreShares team on retirement and ETFs. My name is Dineo, and before I hand over to Chris, who will be doing the presentation, I just want to make sure everyone can hear me. So if you can hear me, please can you lift your digital hand? It'll be the little hand icon. Okay, perfect. Just to run through a few rules before Chris joins. To be aware, you can send your questions throughout the presentation, and we will be taking breaks in between the presentation to address whatever questions or concerns that you may have. So feel free to send your questions through anytime, and then we'll just stop and address them. And if you have any other questions, we'll give contact details at the end. So if you have any questions that are either specific to your situation, or you just want clarity on something that you didn't have an opportunity to ask during the webinar, you will be able to send us queries afterwards. But we'll give those details right at the end of the webinar. Sorry. Now over to you, Chris.
Thanks, Dineo, and thanks to the Standard Bank Online team for hosting us today. Also, of course, thanks to the attendees. Thanks for tuning in your lunch hour. Today, we're going to be chatting about retirements and ETFs. My name is Chris Rule, and I represent CoreShares Business, which is a passive business that issues ETFs on the JSE. We also have unit trusts and manage money for large institutions. But we've done a few of these series, so I might be of these webinars in a series. So I might be referring back to some of the previous webinars and so on and so forth. If you'd like information on them, I'm sure Danea and the team can provide it for you. But today we specifically talking about retirement and ETFs. So what I'm going to do is talk about it both at a pre-retirement level and a post-retirement level. And what I mean by that is I'm going to talk about clients who aren't yet retired but are planning retirement. They may be 20 years away from retirement. They may be 10, they may be 5 or even less. And then, of course, clients who actually are retired and are looking at genuinely creating a portfolio that will help them have a sustainable retirement. So the first question, and it's the question that everyone thinks of, is how much is enough? And really what the key concept to consider is that really what you're doing when you're saving up for retirement is you're looking at replacing your salary. So for 35, 40 years, you've worked and you've earned a salary. And when you retire, you need to replace that salary with some kind of income or with some kind of salary equivalent to pay your bills, to buy your groceries, to go on holiday, etc., etc. So it's a key component is that saving for retirement is actually all about salary replacement. It's not about saving for this big capital lump sum amount. Of course, you will save a big lump sum amount, but the key concept to consider is that you're actually saving for retirement. So in terms of your retirement savings, both capital appreciation and income are imperative. This is at a pre-retirement level, so if you're still working, and at a post-retirement level. So you're ready retirement. And how you can achieve this goal is through portfolio construction, through asset allocation, and that's how you eventually can improve your odds of having a comfortable, sustainable retirement. So how much is enough? Some experts say around 17 times your ending annual salary. That will give you around 75% of your ending salary in a sustainable way throughout your retirement, which in effect translates to you drawing down about 4.5% of your portfolio once you're retired every year throughout your retirement. So you may have heard about the 4% rule. That's a US specific kind of rule, and it's also specific to a very specific point in time when that 4% rule was formulated. We in South Africa are completely different. So, but around 4 to 6, 7% is a reasonable drawdown in retirement. So that's what you've got to consider. If you're drawing between 4 and 6% of your portfolio, is that enough to actually pay yourself effectively a salary throughout your retirement? And that will determine how much is enough. But it's 4.5% is around 17 times your ending annual salary. So when you're 65, you earned 100 Rand a year, you're going to need around 1,700 Rand when you retire to have a sustainable retirement. That's kind of a benchmark. So really what retirement and what saving for retirement is all about is about replacing income. So retirees living off their portfolios are in constant search for income across asset classes to fund their retirement. So to be able to have a constant supply of income is effectively a salary replacement. And pre-retirees equally should focus on replacing income at retirement age, as opposed to just focusing on a large capital contribution or a large lump sum on retirement age. And this can be done by combining both growth and income assets. So in previous webinars, we chatted about asset allocation, and we chatted about how one can construct a portfolio with different asset classes to meet an objective or to meet a need. In a similar way, you can use asset allocation and you can use income production to replace your salary when you retire. So income can be generated through multiple asset classes. Typically, we only associate income with bonds, maybe with property, but income actually can be generated through equities. And I'll show you a very powerful slide coming up about how powerful some equity income strategies are. So it's important to consider, first of all, your scenario, your time horizon, how long you are until retirement, or if you are in fact retired, the fact that you need to rely on that income every day and or from that point onwards, but also to consider different asset classes and the different income characteristics of those asset classes. So here's a little slide that shows when we're searching for income, and as I said, typically only bonds are associated with generating income, but there are different income production or different asset classes that can be used in our total production of income. Starting with preference shares. Now, preference shares is a hybrid of equity and bonds, but typically they have a very high starting yield and no growth. So that income is not going to grow, but it's typically very high, and it's as a dividend. So it's a floating rate instrument. In other words, the rate or the income you'll receive will depend on the prevailing prime rate. At the moment, preference shares are starting income is around 10%. It's a contractual rate. So in other words, there's no variation in the rate in terms of what the issuer will give you, but there is a floating rate. So it's linked to the prime overdraft. There's no growth though. So if the prime rate increases, your income will increase, but that underlying income stream is not increasing, and it's typically very tax efficient because it's a dividend. I do see we've got a question. I'm just going to go through this slide and then we'll tackle your question as that comes from Oliver. The next typical income asset class is bonds. So government bonds, they have a high starting yield, again, around 8.5% at the moment. It's a contractual yield, which means that the issuer of that bond is obligated to pay you the income. And there's again no growth. So typically these are fixed rates. Inflation-linked bonds will be linked to inflation, so there is an inflation protection, but there's no growth component. So typically bonds have a high starting yield. Preference shares have a high starting yield, so they're very great at meeting your short-term objectives if you're retired. In other words, your need for income right now to replace your salary. But in terms of if you look at meeting our long-term needs or our inflation protection, or maintaining the real purchasing power of our money, typically bonds and preference shares are not well placed to protect our long-term purchasing power. I see we've got some questions. Sorry, I'm just going to tackle this because it's around lost sound. Can everyone hear us? We do have a question saying we've got lost sound. It may be specific to the user, but if we could get some feedback around the rest of you, if everyone can hear us before Perhaps. I continue.
Okay, I see one hand. All right.
Okay. Tom, apologies. It seems that everyone else can hear us. It may be something specific to your computer. If you can have a look on your side. So as I was saying, preference shares and bonds, they typically have a high starting income. So they'll meet your short-term needs, but they're not a real protector of your purchasing power as an investor. So you'll see that in our vertical axis on the left, the starting yield is high, but our yield growth in our bottom axis is very low, if none at all. So that's why we talk about it meeting our short-term needs, but not necessarily our long-term needs. The next asset class, which one might associate with income, is listed property. And you'll start to see the relationship between starting income and income growth as we go on. So the starting income of listed property is around 6.5% at present. That's if you're just buying the local property stocks. And they have a moderate yield growth. So yield growth of property stocks is around 7%. So this will have a growth component, which means it's protecting your inflation-adjusted value of your money, and also has a relatively high starting yield. So fantastic asset class to combine in your total portfolio to generate income, but also to protect you against inflation. So your income is growing at around 7%, which means that it's growing at least in line with inflation in terms of that top end of 6%, if not exceeding it in some instance. So fantastic, almost hybrid of high starting yield and high growth in yield. And then an asset class which is typically not associated with income generation, and that's equity. So it has a low starting yield of around 3%, but has a high yield growth or income growth of around 10%. Which means that in the short term, unless you invest with a very large sum of money, it's probably not going to meet your needs if you're already retired. In other words, let's say you retire with R1,000,000 or 10 million Rand, 3% as an income is probably not going to meet your needs. But what will help you when blending these solutions is a very high income growth, 10% being quite conservative in equities. It could range up to 15%. So a company like Standard Bank, we've actually got them in the next slide, has traditionally had a track record of paying and growing dividends over long periods of time. So really, in terms of looking at your total income production, what's really important is combining these asset classes both to meet your immediate needs, but also to protect the purchasing power of your income through retirement. And of course, when we're looking at the pre-retired clients, so now I'm talking about people who are still working and saving for retirement, when you're looking at complementing your current compulsory retirement savings, your Provident and RA savings, you can look at moving from the short-term needs to more of a long-term need. So you typically have a portfolio that uses more equity and properties as opposed to a lot of bond exposure. But just to illustrate the power of starting income and growth, we've got another slide. Before I do that, I'm going to take a few questions to know if you want to read them out, and I'll try and answer them as best as possible.
Okay, so the first question is from Oliver, and basically going back to the first slide, does the 4% mentioned by Chris refer to drawing down or eating up capital of the retirement fund at a rate of 4% per annum?
Okay, I'm just trying to interpret your question as best possible, Oliver. So when I'm talking about drawing 4% of your capital when you're retired, let's say in an example of, let's say, enter John. John's retiring with 100 Rand. Typically, John would be able to sustain a drawdown of 4% of that retirement capital value over a period of, let's say, 30 years of retirement. So, in other words, he's starting with 100 Rand. Of course, that 100 Rand is invested. So that 100 Rand is growing, even though he's drawing against it. But typically, if he's drawing down a rate of about 4%, this is after costs, because I see there's another question coming up around including admin fees, etc. So this is drawing down 4% total. Then that client would be able to sustain his retirement quite comfortably. Now that, of course, in terms of your capital or your income, that 4% drawdown would come from both a combination of income. So in other words, your portfolio generating income through those asset classes we chatted about, but also you may be drawing down some capital. General rule of thumb is that if you're reliant only on income and it's income that's growing, you run a very low risk of actually running out of money. If you start drawing large portions of your capital value, you start eroding the long-term sustainability of your portfolio. So I hope that questions that. Guys, by the way, the 4% is a general rule. Please don't misinterpret this and say, I can only draw down 4%. If you speak to your advisors and if you look at the sustainability, the drawdown can range from 4% to say 6%. Generally, moving above that, you're going to really struggle to sustain your retirement. So I'm going to get on to. I hope I answered that. There's a question around: Am I saying that equities will grow at 10% per annum, including dividends of say 3%? I'm talking in this slide exclusively about income. So this next slide is going to show you what I'm talking about more explicitly. So a few questions around what I was talking about in terms of growth. I'm talking about income growth. So if you that same 100 Rand you went and bought listed equities, you're going to get an income of around 3%, and that's as a dividend. That dividend would typically grow at around 10% a year. So year one, you're getting 3 Rand of your 100 Rand invested. Year two, you're getting about 3 Rand 30 as a dividend. So you can now see the relationship of how investing in asset classes where they're growing their income is very powerful over the long term, but it doesn't meet your short-term needs. So can you live off 3 Rand in retirement? No, you probably need to blend that with bonds to increase that starting income, but you also must understand that you're sacrificing the growth. So this example is a real-life example. It looks at 3 instruments. It looks at SBK is Standard Bank equity, so their ordinary share. It looks at the R203, which is our government bond, and it looks at GRT, which is Growth Point, which is our largest property stock in the market. So when in 2004, and these are all actual, so this is showing you the power of growth. 2004, you had 100,000 Rand to invest. A Standard Bank equity investment would have given you about 4,000 Rand. The yield of Standard Bank was slightly higher than your typical yield, but about 4,000 Rand of dividend income in that first year. The bond would have given you around 8,500 Rand. And Growth Point would have given you around 11,000 Rand. Property at that stage had quite a high starting income. It's now quite a bit lower. But if you look over time, although the bond had a much higher income relative to Standard Bank ordinary income or ordinary equity shares, over long periods of time, because of the growth in income, because of the growth of a dividend stream, that income has caught up and far exceeded the bond investment. So although the equity alone may not have met your short-term needs, it's much better placed to meet long-term needs of inflation, of course, of protecting the purchasing power of your income, but also to generate a larger income component. And the same goes for property. Property growing not as fast as equity, but growing at around 8%. So Growth Point, which now effectively, if you invested 100,000 Rand, the income generated from that 100,000 Rand on your bond is still 8,500 Rand in 2016. It's what it would have been in actual terms. On Standard Bank is now much higher, closer to 20,000 Rand, around 17,000 Rand. And on the listed property is around getting close to 30,000 Rand. So if we extrapolate this another 15 years, typically what you'd see is that equity is actually generating you more income, and property would be slightly behind it. But you can kind of get an idea of how different asset classes now can be used to, when combined, to meet your short-term and long-term requirements of your total income production. So someone who's already retired may have a high proportion of property bonds relative to their equity proportion. Someone who is got 20 years to retirement would be holding more equity in their portfolio because that's going to meet their long-term income replacement need. SBK is Standard Bank ordinary preference share. Okay, I've got a few questions around my view on property, mortar, bricks and mortar versus the actual instruments. We will deal with that at the end. It's not really. I'm talking about listed property here, just FYI, but and I'll deal with that on the end. Um, I've got another question here, which I think I should deal with at the moment. It says, until the share tanks or dividends are withheld. So what you find is that dividend payouts are typically a lot more or less volatile than share performance. Over long periods of time, dividend growth tends to track capital growth in a share. But you'll see 2008 here, Standard Bank, their dividend income dropped slightly through the global financial crisis, but not as much as their capital value. So that's why combining a whole a combination of asset classes, first of all, to diversify away from those specific risks to an asset class are important. But also just to note that typically a dividend is a lot less volatile than the capital valuation. If you're only drawing down dividends, you can almost forget about capital prices in many respects. Okay, GRT is growth point property, as I mentioned earlier. So you'll notice that I've focused a lot on asset allocation as opposed to just looking at buying individual shares or holding only equity or only property or only bonds or only prefs. It's more about creating a holistic solution and holding all the asset classes. So here you can see, and this ties back to our previous slides on asset allocation. I'm sorry, I am cognizant of time, so I'm trying to get through this presentation in time-efficient manner. Asset allocation plays a significant role in portfolio construction. So why it does play a significant role is because you're diversifying away asset class specific exposures, equity, property, by holding equity, property, bonds, etc. It also allows you, as we talked at length about in our previous webinar, to align your needs. So by targeting or matching your needs with an asset class, you typically also match your needs in terms of your time horizon and your income production. So income targeted portfolios can be constructed by combining multiple asset classes. Of course, these asset classes can be accessed through ETFs and by buying ETFs. So why use multiple asset classes? Well, again, you can align your needs and you can get additional diversification by holding different asset classes. And typically, this is also from that last presentation, but this is showing you time horizons and asset allocations and how you can use asset allocation to meet your long-term needs. So cash, of course, is very short-term time horizon within 1 year. A low equity fund, I'm using equity here just as kind of an anchor to understand how the rest of your asset classes would fall in there. Low equity fund, around 35% equity exposure. A medium equity fund would be around 55, high equity closer to 65, 75, and then full equity is, of course, full equity. Generally, when we're talking equity here, we're also talking growth assets. So property would be considered a growth asset. And what that means is it's more volatile in the short term. In other words, guys, we're talking about prices, and if a price drops or increases, property and equities have more volatility of price performance. And bonds less. So that's typically why you would allocate in this time horizon. But again, if you'd like to see the old webinar, it is available, and when we talked at length about asset allocation. Today we're talking about retirement and looking at income production and asset allocation. And I'm gonna chat a bit about costs here as well. So this is just an illustrative example. Please, again, this is not literal, so don't take it literally and go and this is an illustration and go and combine a portfolio like this, but this is an idea of how income production and asset allocation work together. So we've here got an example of combining all asset classes, both local and offshore, and what kind of income this portfolio would produce for you and what kind of growth that income would experience. So in other words, if you had 100 Rand, I'm going to jump ahead a bit, but if you go to that bottom line, this portfolio on a gross basis before costs would produce you around 4.4 Rand 80. But what's important is that income would grow at around 7.2% a year. And how's that combined? So we've got a healthy allocation here to equity. We've got equity at a slightly higher yield of around 3.5%. Of course, you can buy ETFs which have more of an income component. So, for an example, Dividend Aristocrats with the core shares is a core shares ETF, and excuse me using our product, but that has a higher income than the general equity market. It buys shares with good income or a dividend track record. So around 3.5% is attributed to your equity portion, around 6.5% to your property, so on and so forth as we go through the different asset classes. And combined, the income of this portfolio is around 4.8%. So you kind of get the relationship now. If we drop down the equity exposure, increase bonds and prefs, we're going to get a higher starting income. We could go all the way to, like, let's say 9-10%, but then we'd have only bonds and prefs, and then we'd have no income growth, which means, yes, on your 100 Rand investment, you might be receiving 10 Rand today, but you're also going to be receiving 10 Rand for the rest of your investment life. And what that means is, as inflation increases, you start to destruct the quality of living, your standard of living, because you have less money in real terms. So you can't go and buy the same basket of goods year in, year out. So it's important to consider inflation when you're constructing a multi-asset retirement portfolio for in the South African context, because our inflation is also relatively high. In the same way, if you're pre-retired, you can drop the starting yield because you don't need it down to, let's say, 3.5% by just having equity, but knowing that growth is going to be 10 or 15%. So by the time you are retired, the income that your portfolio is producing is high. And as I said, ETFs are perfectly placed, and Smart Beta, which was one of our podcasts we've done, is perfectly placed to give your portfolio whose aim is specifically an equity income strategy or a property strategy. So this is just an example. And we chatted about costs and stuff, and this is one of the powers of passive. We looked at what ETFs track these different asset classes. You'll notice we've got quite a healthy offshore component which dilutes the income quite a lot. So that 4%, let's say you excluded offshore and just went local here, that 4.8% would probably be closer to 6.5% in this portfolio. But we believe that it's good to have a diverse portfolio, so to have some offshore is very important. But let me just give you an example. If you use this just using ETFs, you're going to have a typical weighted average cost of around 0.35%, which means your net of fees yield is around 4.25%. So yes, it does restrict that starting yield. Of course, that has no impact on your growth. Your growth is still 7.2%, so the fees don't have any impact on growth, but you've got a lower net yield, which is cash in the bank for you as an investor. Now, why passive is so powerful is because it can still produce about 4.2, 4.3% as a starting income. So 4 Rand 30, 4 Rand 20 on your illustrative 100 Rand. If you were to move into an active environment, so you were to buy, let's say, a unit trust, and you can think of any of the big brands, the average balanced fund, or if you were buying building blocks and doing this yourself, is around 1.5 to 2%, which means that your net yield goes from, let's say, 4.3% using passive building blocks to around 3%, let's say 3% at a 1.8% level, to around 3.5% at a very cheap active level. So what this means, literally for you as an investor, is that your net income is much lower in an active solution than it is in a passive solution in this example, which means less cash in the bank. And where that cash is going is it's quite literally being consumed by fees. So that's why being cost sensitive is so important in your post-retirement basis. So yeah, again, that was a very simple illustrative example of how you could do this. And one can tailor upweighting equities and property if you've got a longer time horizon, or downweighting it slightly if you've got a shorter time horizon. And this is just an illustration. So we're going to take a whole lot of questions now. In conclusion, retirement is all about salary replacement. That's the key objective. A lot of people forget that. They talk about what's your big number. Is it 10 million rand? Is it 2 million rand? Is it 100 million rand? It's actually all about replacing the cost of your lifestyle when you do retire. And if you can replace that 100%, then you're going to have a fantastic retirement. And it's about searching for income through different asset classes. So we typically only associate income with bonds and maybe with property, but equity is a powerful income producer in over long periods of time. And of course, one can construct these portfolios by combining ETFs and by getting exposure to the asset classes. So we're going to start taking some questions. We've already got some. I'll let Daenerys step in. And
Great. Thanks, Chris. So Ian has a question around offshore funds, and I don't know if you can actually, if that's an individual, like people-specific type query, but basically he wants to know if your offshore funds are more than 20% of your portfolio, I'm assuming, would you bring money in?
yeah.
Because yields are high in SA. I think that's what you mean, Ian. Yeah, in. So could you perhaps...
Sure. So again, I mean, that 20% we've got there, Ian, this is purely illustrative. Please don't use it in the literal sense, and you must go and design your portfolio around that. You obviously have very specific needs and requirements, and this may be a portfolio within your holistic planning where you've got provident fund, you may have a retirement annuity, so on and so forth. So the question is, what if offshore funds are more than 20%? Would you bring in your income? Would you bring in income or more funds in onshore to meet your needs because of higher yields locally? As Danelle said, that is very specific. Typically, just to give you an idea of the pros and cons of being, when you're in retirement and you're relying on income, the pros and cons of being offshore versus onshore. If you're onshore, what we find is that you've got a lot less variability of income. That is because there's no translation impact of currency. So let's use the example of Standard Bank as an equity instrument. If you bought it in rands and they were paid a 4 rand dividend in year one, in their terms, that was the money they're earning. They are generating that income through selling banking products and asset management and online, etc. Very South African specific. Next year, they grow it by 15%. So the following year, you're going to get, let's say, 4 rand, 45 or something as a dividend. Now, let's say Standard Bank was domiciled in the UK and it generated all its income in the UK. On year one, you bought £100 worth of Standard Bank, which translated, or let's say you just bought a translation back into rands as a 4 rand dividend. And let's say in pounds, they grew their dividend by that same 15%. So let's say they were paying out a pound equivalent of 4 rand 40. But in that same year, the rand strengthened significantly. It strengthened by 50%. What you're going to get as an investor is you're actually going to get a much lower dividend. So there's a lot more variability around income when you're investing offshore because of the currency translation effect. And that's not because of anything fundamental underlying in the asset class. So what you have to accept when you're investing offshore is variability around your income or around your capital as a function of currency, not as a function of anything fundamental. So if you can meet all your objectives in terms of rands, then you can by all means go all offshore because you're not reliant on the income generated offshore by in terms of your requirements. So as I said, it's a very specific question in terms of what exact percentage you should be offshore. In terms of the regulations, Reg 28, which is our regulations which oversee our pension funds and provident funds, they would dictate that you can only be 25% offshore. But if you are in your discretionary capacity, in other words, you're not in a provident or RA environment, you can actually go 100% offshore, of course, depending on the various asset restrictions. Sorry, I'm not answering your question specifically, Ian, but it's a very investor-specific question. So that 20% was illustrative in this example. We do believe that it is important to have offshore as a diversifier within your portfolio.
Okay, and Mashan wants to know what are some of the examples of listed property and equities? I'm not sure if I suppose the Standard Bank and Growth Point were two examples of
Yeah.
listed and
Yeah. So the example of listed property and equities. Of course, equities are all the shares we hear about on the news, etc. So all the big companies, they literally list their ordinary shares on the exchange. You can buy them. When you buy them, what you would be receiving in most instances is a dividend. And that company, as a shareholder, you would hope that they would grow that dividend by growing earnings. And that's the direct translation. Fundamentally, that's what you're getting when you're buying an equity share. Listed property are the big listed property funds. So Growth Point, for example, is our biggest listed property fund. They literally hold properties in their portfolio. So all the big buildings that you see, most of them are owned by listed property companies, and they will charge, let's say, Standard Bank a rental. That rental is a contractual obligation for Standard Bank to pay income, and typically that would come with an escalation clause. So that's where the growth in property, well, a lot of the growth in property comes from, and then they list units in it. So you're buying an instrument which gives you exposure to property. So that's where they get their starting income and their growth in income. I hope I've answered the question there.
okay. And Noktula, I don't know if you want to talk about actual bricks and mortar property. A lot of people, and I know it's not just Noktula, there's just a sense that people will buy their homes because they believe in future it will be an income producing investment. So can you perhaps talk to that?
Yeah, sure. Look, the debate rages on whether you should be buying property through listed property, so buying effectively a portfolio of commercial property in a stock version, in other words, buying it on your online portfolio, versus actually going out and buying a flat and renting it out and receiving an income. I guess the pros and cons are as follows. In terms of bricks and mortar, if it's your primary residence, you must remember that asset is not actually generating you any income. It's a leisure asset. You living there. You may get capital growth when you sell it in 10 or 20 years. Fantastic. But you can't really bank on capital growth. If you look at physical property over the last 10 years, let's say in South Africa, it's pretty much gone sideways in terms of residential stuff. So if you look at rental properties, and I'm going to compare like investment property, not so I'm excluding your primary residence out of this. So you go buy a flat in Ilovo and you rent it out to Dineo, let's say, and she pays you a monthly rent. The pros are that you can go and get gearing from the bank quite easily on that if you are credit worthy. So in other words, you can get access to capital. You can generally get a higher income, but that's when I say I'm saying generally as a caveat, it's not always higher. But then you've got the bricks and mortar. You can feel it, touch it. You've got a lease. You've got an escalation clause. Of course, the cons of that are you have to administer that property. You need to make sure the lights and water are paid. You need to make sure your tenant's paying their rent. You need to make sure the building's in good condition. There's very expensive upkeep costs. Versus going and buying listed property where you literally are outsourcing that to professionals who buy big portfolios of companies. In other words, you don't have any Dineo specific risk when you buy Growth Point. You've got risk to a whole lot of underlying leases, like a pool of underlying leases. So the debate rages on. Generally, it's for an investor, it's much easier to buy listed property and hold it, and you're getting effectively good exposure to commercial property. But different courses for different horses, I suppose, in this instance.
Okay, and then Ben wants to know if I want to invest 50,000 Rand in bonds, how would I go about it? In what form would I receive the 8% income? I suppose again that's very specific, but maybe we can talk about the different types of ETFs that track bonds.
Sure. So at the moment, there are a few bond tracking ETFs. Unfortunately, CoreShares we don't actually have one, but ABSA has a bond ETF, Ashburton has a bond ETF. Satrix has bond ETFs. So you can actually go and access a pool of bonds through these ETFs and get that access through there. And the nature of the income would typically be interest. So that is the nature of your income. It's not a dividend, it would be interest. So taxed at your marginal income tax rate.
Yes. And I suppose the other thing, Ben, you should be aware of is generally bonds are available to wholesale investors. So one other way of accessing bonds, if you don't want to go through ETFs, is through retail bonds. But that also, again, depends on your investment horizon, and because retail bonds are split between 2, 3, and 5 years. And that's generally the time frame that you can invest in. So you really need to think carefully about when you're investing in bonds, what exactly are you working towards? Will you need the money during the period of the investment or not? And which is best? As Chris mentioned, there are inflation-linked bonds, and then there's other types of structures within bonds that you just need to be aware of before you put your money in there. Okay, and Bosman says, do I have to open a retirement annuity platform with a provider to be able to claim back tax on contributions from SARS? Or can I just buy structured ETFs and claim back contributions?
Bosman, to answer your question very simply, it does have to be within a retirement annuity wrap. In other words, an ETF that may qualify for an RA doesn't necessarily mean it is a retirement annuity, and therefore you can't claim back that tax. So if you just go on your online portfolio and buy an ETF that qualifies in terms of Reg 28 for an RA structure, you can't actually claim that back. You have to buy it through a platform with a retirement annuity option. Is a simple answer there.
Okay, and then Ben again wants to know, how will ETFs help to increase your retirement income?
So, Ben, look, ETFs are simply exposures to asset classes or to investing themes. Like, let's use equities for example. The general market will give you an income of around 3%. So, if you buy an ETF that tracks the general market, you're going to get an income of around 3%, less fees of around 20 basis points. So 2.8% would be your dividend income. Or you could go and buy an ETF that is specifically looking to buy companies with good dividends. So like Dividend Aristocrats ETF. That has a yield of around 3.6, 3.7%. So you're going to be getting a higher net dividend after costs. Why are ETFs probably placed better to generate income than active portfolios is because their fees are so much lower. Now, fees are generated by taking away income from investors. So when we take our fees off our ETFs, it comes directly out of your income, not out of your capital. So if our fee is, let's say, 0.2% on our top 50 ETF, and a general equity active funds fee is 1.5%, we will be able to give you 1.3% more income just because we're not taking the fees away. And it's really a structural thing, and it's as simple as that. So that's why ETFs and passive in general is really well placed to service clients with good after costs income.
Okay, and then Bosman, your second question about having 15% retirement contribution from your employer and wanting to increase that. Now, because, again, retirement is a very specific to you situation, it is always best to rather consult with a financial planner or provider. Unfortunately, we cannot tell you whether or not it's a good idea to increase with your employer or find a new platform. Our presentation is basically how can you better prepare yourself for retirement, but the nitty-gritty of that decision making we cannot actually do simply because you need to sit with somebody who actually has a proper needs analysis and has gone through your specific situation and can actually recommend what you need to do. Chris, I don't know if you want to add anything to that.
Yeah, no, 100%. It really depends on your personal circumstance and your personal preference. So you mentioned that you've got your current employer is contributing to an umbrella fund that you don't like. You may not like it for a number of reasons, high fees, or you just don't like the underlying options which are available for you to invest. So by all means, rather than increasing your 15% with your current employer, go and buy an RA where you've got more control. Of course, an RA is a retirement structure, so you can't access that money just like any RA. But that is a very personal preference, as Daneo said. So there are options available to you, and there's a lot more product available now than there was, say, 5 years ago in this space, and a lot of transparency around this stuff. So by all means, go and do your own retirement annuity to as long as you're contributing over and above what your current forced contributions are with your current employer.
Okay, and for everyone asking if the presentation will be available, yes, we'll put it up on the website tomorrow morning, so you'll be able to have access to it. Are there any more questions related to points in the presentation, or is that it? Okay, we've got a question from Ian. Ian says, thanks, Chris. Do core shares advise on appropriate ETF portfolios to achieve these diversified target yields?
Ian, unfortunately, we don't offer advice services. We offer building blocks products which advisors can use. So no, we the short answer is that we don't provide advice of these target yields. But in terms of all the underlying asset classes, we do have what we call smart beta funds, which help you. So if you want 50% equity exposure, but you want a dividend theme, we've got a Dividend Aristocrats ETF, so you can simply buy that. So you don't have to worry about sifting through shares and finding the right shares. But unfortunately, we don't have an advice service that targets specific incomes.
Okay, and then just for Terence, so the webinar will be available on the online share trading community and the online share trading website. So if you have an online share trading account, you'll be able to log in and access it through the research portal. And then, Ian, unfortunately, we don't have a list of financial advisors or providers, but if you have a financial planner that you deal with, they should be able to assist you with your query in terms of appropriate ETFs that you can add to your portfolio to be able to reach the targets that you're hoping to reach. Okay, before we wrap up, are there any final questions regarding retirement and the presentation? Okay, Chris, I don't know if you just want to tell everyone how they can reach you if they'd like to reach you, or and then I'll...
Sure. So if you have any questions that relates to this ETF, please email us at info@coreshares.co.za. And we'll respond, or you can reach out to Daneo and her team if there are any platform related questions, or I suppose any other questions, please do so.
Yes, so you can send an email through to securities@standardbank.co.za, or you can go to our community under the talk section and you'll be able to post your question there. Those are two very good platforms. Okay, so one other, a question we had from Johan. Johan says he has an existing tax-free investment account, which he accesses every day, but he doesn't know what to buy. Can we have more future webinars to guide people? Yeah, I think in the future we'll definitely have more tax-free focused webinars to just sort of help you decide how and what you should be looking at. Okay.
Perfect. Thanks everyone for joining us, and thanks again to Daneo and her team for hosting us today.
Thank you everyone, and have a lovely week.